Hi believers, this is Nishant from Waya team. Today, we will discuss what are the key levels of major indices and how much room on the upside we can expect. In the current situation, managing risk is prominent because of geopolitical worries, upcoming elections, and the result season. As usual, let's start with the Nifty index first. The Nifty index has formed an upward channel with a lot of choppiness since February 2024. The choppiness makes it difficult to carry overnight positions. Also notice that at every new high, the next selling candle is very large. And in some instances, there is a gap down as well. Money is made in trending situation only, whether it is up or down. Therefore, we believe that Nifty will continue the uptrend if it closes above the recent top or can see a 2 to 3% correction if it closes below 21,800. Till then, it will be in a consolidation phase. Adding further evidence to our analysis, the Fibonacci study shows that the recent top of the 22,775 is a short term top, and 21,800 is a very important support for Nifty. The Fibonacci study echoes our price action analysis on the daily chart. Moving to the Bank Nifty index, the index is in a long term upward sloping channel, signaling a bigger range of consolidation. Like Nifty, Bank Nifty has also been very choppy, but with some trending moves. If we go with the Fibonacci study, the target of 50,000 is open. But it is important for Bank Nifty to close convincingly above the gap, which increases the probability of making new highs. One note of caution: Nifty and Bank Nifty both have a gap down at the tops. This has to be taken seriously. That is why we say that if we close above the gaps convincingly, we can make new highs. Briefly touching upon small and mid cap index, both index are at their life highs, outperforming Nifty and Bank Nifty. The rise in indices is supported by earnings. Therefore, it is important to remain invested in stocks which have earnings growth, earnings visibility, industry which is in tailwind, and with a good management. Going forward, we expect both indices to outperform Nifty and Bank Nifty. We have close to 200 stocks in our coverage from small and mid caps, which we repeatedly recommend to our subscribers. Also, it is important to keep the valuation and the risk and reward in check when you are buying small and mid cap stocks at these valuations. One of the theses we have is to follow the liquidity. It helps you to find the direction and increases the probability of success. This information will also help you to understand why small and mid cap stocks will outperform Nifty and Bank Nifty. With the significant investments in industrialization and infrastructure by US, Middle East, and India, money is flowing into sectors benefiting from the government spending. Among the biggest beneficiaries are the capital good companies. Given their diverse product offering tailored to industries targeted by government investments. That is why we have seen many small and mid cap stocks order book reaching life high. While it may seem that many stocks have already seen considerable growth, it's important to note that we are still in the middle of this cycle. Any dips or correction should be viewed as an opportunity, especially if you have done your homework or you can rely on us. To name a few, focus remains on sectors like capital goods, defense, railway, and some power equipment providers. Conversely, it's advisable to avoid large cap IT companies. This isn't to say they won't perform, but there are more promising opportunities. Two primary reasons support this stance is firstly the growth guidance of large IT company is on the decline. Secondly, the government focus is shifting towards industrialization, making sectors aligned with this agenda more appealing. Concluding our analysis, the major indices are trading near life highs. The indices are making higher highs and higher lows. On charts, we still have a visibility of 3 to 5% across all indices until important supports are broken. Indian markets are reacting to temporary shocks coming from geopolitical tensions and US inflation worries. Earnings season for small and mid cap under our coverage has been good so far in the month of April. This quarter is very important because of two reasons. Election in India. Any negative surprise or no majority in government will not be taken well by investors, and we may see a sharp correction. Let's wait and watch. The second is commodity prices. The prices of copper, aluminium, steel, crude have risen a lot, causing pressure on margins. Although this has a lag effect, it will be reflected in the results this year. Our stance is cautiously bullish, looking at the global situations. Indian markets remain buy on dips because of the growth opportunity for the next couple of years. At Vaya, we make our best efforts to keep you informed about markets through our weekly bite and sectoral update. Thank you and good night.